Why accounting for evolving assumptions and risks is necessary to reinvent your business. Many organizations have been through transformation programs before, but with digital transformation being so prevalent, we see a new wave of companies reinventing themselves. However, one thing has stayed the same. Most of these transformations fail because companies don't consider the changes in their business model and market assumptions. Let's see why accounting for evolving assumptions and risks is necessary to reinvent your business. What does it mean to account for evolving assumptions and risks? Accounting for evolving assumptions and risks means identifying an assumption in your business model that is currently valid and then tracking that assumption over time. The assumption might be about the market, the technology, the customer, or even your own capabilities. Some examples of evolving assumptions include: the way your customers buy your product is changing. The capabilities of your technology are not keeping up with your strategy. Your competitors are evolving their business model. Your revenue model is shifting. By accounting for evolving assumptions and risks, business owners can assess their business model to evaluate any potential changes that need to be made to stay competitive. This means staying informed on the latest market developments and industry trends and understanding your strengths and weaknesses. Why is accounting for evolving assumptions and risks necessary? Many companies need to account for changes in the market and how their customers use their products. This is especially true when it comes to digital transformation. If the people driving the transformation are not engaging with customers and understanding their changing needs, the transformation will not be successful. Accounting for evolving assumptions and risks is necessary because business models and markets are ever evolving. Ignoring the changes in customer preferences, market trends, technology advancements, and competitive strategies can leave your business vulnerable to disruption or failure. By periodically assessing assumptions and understanding how they impact your business model, you will be better prepared to adjust your strategy as needed to stay ahead of the competition. Three ways to account for evolving assumptions and risks. You can account for evolving assumptions and risks in three ways. First, define your current business model. This includes everything from your go-to-market strategy to your revenue model. Next, define your target business model. This should be a model that is customer-centric and customer-driven. It should also help you reach your organization's strategic goals. Finally, define the risk events for each assumption. This will help you identify which assumptions are most at risk and will allow you to monitor them over time. This can be done using a risk table, risk tree, or fishbone diagram. Tip 1. Define your current business model. When you are defining your current business model, you should include all aspects of your business, including how you go to market, your revenue model, your value proposition, and your customer segments. This will help you understand how customers are currently engaging with your product. By understanding your current business model, you can identify your strengths and weaknesses. Tip 2. Define your target business model. Now that you've defined your current business model, the next step is to define your target business model. When you define your target business model, you're looking to optimize your business for the future. You should define your target business model based on your organization's strategic goals. This can include increasing customer retention, reducing customer acquisition costs, increasing customer satisfaction, or increasing the lifetime value of customers. Tip 3. Define the risk events for each assumption. Finally, it's time to define the risk events for each assumption. A risk event is something that could negatively affect your business. It can be an external event, such as a regulatory change or a natural disaster, or an internal event, such as a team member leaving their job. You can account for evolving assumptions and risks by identifying risk events and determining the likelihood of each event occurring. Conclusion. Many companies fail to account for changes in their business model and market assumptions. Transformation programs are often unsuccessful because those driving the change don't fully understand customer needs. By accounting for evolving assumptions and risks, you can be aware when they are no longer valid and adjust your strategy accordingly.
Be sure to like and subscribe. And check out the links below.